You just ran 3 profitable loads all the way from Atlanta to Dallas. The math says you're making good money, but when you check your business account to pay for tomorrow's fuel, the balance is effectively zero. When you take that profitable ledger to a traditional bank, they don't see your margins. Their automated systems see your transportation NAICS code, and they deny the application. The banking industry practices what amounts to NAICS redlining. They flag the entire long-distance trucking sector as too volatile for standard credit lines, regardless of your individual performance. To even get past the algorithm, banks demand a personal FICO score above 680 and a history of zero cash flow volatility. In the real world of freight, those strict criteria trigger a 95% rejection rate for carriers. This 2x2 matrix maps out the reality of where trucking operators can actually get money. We are plotting the speed of funding on the bottom axis against your likelihood of approval on the side. As you can see down here in the bottom left corner, traditional bank loans are the absolute worst option for an active carrier. They take 60 to 90 days to process, and almost nobody gets approved. Large depository institutions have effectively abandoned small fleet operators. To keep your trucks moving, you must look outside the local bank branch for liquidity. Operating a commercial truck carries immense, non-negotiable fixed costs. As of 2024, the industry average marginal cost to keep a rig moving sits at exactly $2.01 per mile. That $2.01 per mile leaves your account the second you hit the highway. But the freight brokers operate on a net 60 payment term, meaning you won't see that revenue for 2 full months. This creates a massive cash gap. Without upfront fuel and maintenance money, owners are forced to park their trucks in the yard or pass up highly lucrative new lanes. A lack of available freight is rarely what kills a growing carrier. What actually destroys a trucking business is the fatal timing mismatch between instant daily expenses and delayed revenue. Looking back at our capital matrix, we need to focus on the top right quadrant, the options that actually approve carriers quickly. But one of these options is a severe trap. Merchant cash advances, or MCAs, heavily target the trucking industry because they promise to deposit cash directly into your business account within 24 hours. The hidden trap is their legal structure. MCAs are not loans. They are legal purchases of your future receivables. That distinction gives them the right to trigger aggressive, non-negotiable daily or weekly draws from your bank account. This descending line chart demonstrates the debt stacking spiral. Daily MCA draws quickly chew through your margins, driving cash reserves negative. To enforce this, contracts include a UCC1 blanket lien, legally paralyzing every asset if one payment bounces. When those daily draws drain your operating account, you miss non-negotiable compliance payments, like your commercial auto insurance and quarterly IFTA taxes. Using an MCA frequently results in missing these non-negotiable compliance bills, which leads directly to a revoked DOT operating authority. There is a structural, safe alternative sitting right next to MCAs in that high approval quadrant, freight factoring. Factoring involves selling a completed invoice to receive up to 97% of its value in cash immediately, bypassing the 60-day wait. It bypasses your personal FICO score entirely. The underwriting is instead based on the shipper's high corporate credit rating. The trade-off for this speed is clear. You relinquish a small fee on the total value of that invoice. You pay a small premium to ensure your trucks stay fueled and your business survives. It is a calculated, strategic cost and a much safer path than risking your entire fleet on toxic daily MCAs. If your fleet is established and generating over $20,000 a month in gross revenue, you can bypass standard underwriting friction and secure a factoring line. That $20,000 monthly volume, which is roughly 4 to 5 completed loads, serves as a critical threshold, proving to factoring companies that your operation is stable and consistent. When you prove consistent volume, lenders can size a funding facility exactly to your revenue generation. You don't need to post real estate or heavy machinery as collateral. This checklist outlines the administrative paperwork needed to get funded in 24 hours. Left side, universal documents, bank statements and ID and P&L statements. Right side, trucking documents, DOT and MC numbers, insurance certificate, AR aging report, and a sample invoice. That AR aging report is your most important tool. Having it ready prevents the factoring company from manually auditing your payment history, saving days of frustrating delays. Your leverage in this industry doesn't come from your credit score. Proactive administrative preparation is exactly how you transform your status from pending review to funded overnight. When selecting a factoring partner, your final critical decision is choosing between a recourse and non-recourse agreement. A non-recourse contract means the factoring company absorbs the total loss if your freight broker goes bankrupt. The trade-off is you pay slightly higher fees and are restricted to hauling only for brokers the factor pre-approves. The BusinessLoan.Directory marketplace connects operators to over 75 specialized transportation lenders, allowing you to review actual terms without triggering a hard credit pull. Successful carriers survive the net 60 gap by choosing transparent, calculated trade-offs over the desperate measures that threaten their independence.